Hey guys, happy Friday. It is September 20th. We've got a lot to go over today for your market update, and I'll give you a quick rundown. We're going to talk about the Fed rate cuts, mortgage rates, what they're doing, the yield curve, a possible issue with some inflation things that might come here in about 10 or 11 days, and go into some details. So, long story short, of course, the Fed cut rates on the 18th on Wednesday by 50 basis points. We'll get into what that actually means here to mortgage rates in just a second. And interest rates really kind of just shrugged it off. If you're seeing a lot on social media that interest rates actually went up on Wednesday for mortgage rates, kind of true. I mean, we're talking about just a tiny little bit. So it's not like oh no, they went up. But basically, as I had mentioned before a few times, it's not what everybody thinks is going to happen, is just going to happen, but there's also a projection of this is what we're going to do when we're talking about the Fed. This is what's going to happen on the 18th, and then it happened. So it's what was expected. So there wasn't a big surprise that all of a sudden mortgage rates were going to get better. Some things change and boom, we interest rates get better by a ton. If you know as an investor that that something's coming, you're going to get ahead of it. So we kind of thought that the mortgage market had already essentially priced in that we were getting 50 basis points, 25 to 50 basis points on Wednesday. It was already priced in. So there's that to consider. But interest rates are essentially flat, and they've been flat essentially since like September 10th. Really haven't moved a whole lot. I'm going to put on a chart here and show you a little bit about what I'm talking about. So if we look at the chart here, you can see that on September 10th, mortgage-backed securities hit a certain price. Now this is a ceiling of resistance. So, you bounce a tennis ball in a room, it's going to go up, hit the ceiling, and then it's going to come back down, hit the floor, come back up, and so on. So there has to be information news that's going to get us past this point. We had hit this point before many times, but it hadn't been for 2 years. So when we got there on September 10th, everybody was waiting for any additional information from the Fed that things are going to get better than expected. When the Fed cut the rates 50 basis points, it was expected. When they made their announcement and their commentary and all of that, it was expected. So nothing really jumped out at the markets basically, or traders, to say we should be getting better pricing. And so that's kind of where we stopped. Now, when we talk about trading and whether somebody's going to buy or sell, this is where, we're at a point where you would consider on a technical signal, do I sell right now? Prices, as you can see, have been getting better and better and better, and nothing moves in a straight line, of course, so it gets better and worse, better and worse. And then we're at this high point, and they go, well, do I need to sell or not? Well, do I have any news that tells me I should stay in this longer? It's going to continue to get better, or do I take my profits right here? And that's kind of where there was nothing really dramatic to cause that change for interest rates to go, mortgage bond pricing to go above this line and make mortgage rates better on Wednesday. And so we had a little bit of profit taking on the day, not very much, and we're still just pretty much flat on the week, actually flat since, the last 10 days. So that's kind of what happened on Wednesday and where we're at today. Now, the other thing that with this cut, and as things have been kind of working itself out, is the yield curve. So short-term versus long-term yields, which one's paying more? We had an inverted yield curve until not too long ago, and then it's all just been solidified. It's going to steepen now with these cuts, where you're going to be making more on your long-term investments versus short-term and so on. So what does that do for mortgage rates? Is essentially bring back ARMs. So this is going to be a conversation where adjustable rate mortgages for a long time have basically been useless. There was no reason for us to use it except for certain circumstances. And if you were going to get an interest rate of 3% on a 30-year fix, why would you do an ARM anyway? So with interest rates going up so much, the yield curve being inverted, there was no point in also doing a adjustable rate mortgage, or not very much benefit for the risk, when mortgage rates on a 30-year fix were 7.5. Well, an adjustable rate mortgage was very similar. So why would you take the risk? This is going to normalize now, where adjustable rate mortgages over time, it'll take a little bit, But those interest rates might actually come back and start to look a little bit better, where we can have some different options for the buyers to go, okay, well, here's a 30-year fixed. It might be at 6.5%, but you might have an adjustable rate mortgage at 5.75, let's say. As these things come down, then you would see 30-year fixed at maybe 5.5, but an adjustable rate mortgage might be at 4.75 as this continues on through 2025 into 2026. So keep that in mind when you're talking to your buyers. That there might be in the future, in the next couple of months, some additional financing options for them to look at. Now, the next thing that could be an issue is coming up here very soon, where we might have some issues with inflation. The largest union in the country is talking about going on strike on October 1st. Now, this is going to affect ports on the East Coast and essentially about 50% of all of the goods in the United States. The reason that matters, one, is obviously strikes are usually for better conditions, working environment or pay, and so you can have wage-based inflation because of that deal, whatever they cut to make more money. That's going to be wage-based inflation. Inflation is not good for mortgage rates, so we could see a little bit of a challenge there. But also, if they go on strike, that's going to cause 50% of the goods to be kind of up in the air in the United States, where it's like, man, when we have supply chain issues, it causes cost of goods to go up, and that's also bad for inflation. So we'll have to keep an eye on that, but it is something that in the short term, while we have hit this point since September 10th, that could be something that causes an issue, and traders will pull back and pull some of their money out, have a little bit of a sell-off in mortgage bonds, mortgage-backed securities, where interest rates kind of flattened out right now, and then we'll start to go up here for a little bit, and then they will start to come back down, because again, nothing moves in a straight line, and we might see that play out in the next probably 10 or 11 days. So all that information, is good talking points for you with your clients, with your buyers, with your friends and family, as everybody's wanting to know what's going on with the real estate market and mortgage rates and all of that. Overall, interest rates for mortgages and interest rates in general are expected to come down. There is another video, of course, that I went into detail on the Fed rate cut and what rate that affects and how it affects mortgages and all of that you can watch to get some more information on why interest rates are doing what they're doing and how the Fed doing this cutting cycle, how that's all going to apply to mortgages. Feel free to take a look at that. But overall, expectation is mortgage rates should continue to come down. They're going to, and inflation is going to come down. We should see all that kind of play out here from now until, roughly end of 2025 into 2026, where the Fed is expecting inflation to be at their 2%, benchmark. So we could have a good run where interest rates just continually come down. Again, nothing moves in a straight line, so they'll come down and go up a little bit and then come down and then go up a little bit and then come down even further. So watch for that. There'll be a bouncing around, of course, all over the place. But overall, interest rates are coming down. Good for everybody. We'll also put some extra pressure on buyers, though, now that there will be more buyers coming into the market, and then your sellers will now have maybe multiple offers coming in on properties and that kind of situation. So I hope you guys have a great weekend, and if you need anything, always feel free to reach out to our team, and we'll talk to you again next week.